Markets are rarely random. Price movement is not accidental. It is the visible outcome of a deeply hidden conflict. This conflict pits knowledge against ignorance. It pits patience against impulse. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. The complete framework for mastering this professional approach is detailed in Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless text containing his foundational wisdom on risk management, judging market action, and establishing trading as a serious business. For maximum clarity, seek the annotated edition by Max Davidson. This version includes the original text alongside explanatory notes that clarify the context for the modern reader. The link to this book is in the description below. Richard Wyckoff's work centered on understanding this underlying battle. He reduced all market action to a single governing principle. This principle dictates every price change. It governs every time frame and every asset class. It is the universal law of supply and demand. The market operates like a massive continuous auction. Price discovery occurs at the exact point where the two opposing forces meet. These forces are supply, which represents selling pressure, and demand, which represents buying pressure. When demand overwhelms supply, the market must rise. It must move higher to attract sellers willing to part with their inventory. The existing demand absorbs all available supply at current prices. Conversely, when supply overwhelms demand, prices must fall. Lower prices are necessary to attract new buyers into the market. The volume of selling pressure exceeds the existing desire to purchase. The conflict itself is not just numerical. It is fundamentally psychological. Professional market operators understand this relationship perfectly. They manipulate the natural imbalance to acquire or distribute shares. They know that the public reacts predictably to fear and greed. Every transaction requires two parties. One party must be selling inventory. The other party must be demanding that inventory. This is the nature of the market transfer. The essential question is never simply about the total volume. The vital question is always about the intent behind that volume. Who is doing the buying? Who is doing the selling? Are the informed professionals accumulating inventory? Or are they distributing their holdings into the hands of the uninformed public? Wyckoff structured his entire method around answering this one crucial question. He identified that the market is dominated by two distinct types of traders. There is the informed, patient operator who understands the law of supply and demand. Then there is the uninformed, impulsive trader who reacts to news and emotion. The market mechanism is designed to facilitate the transfer of wealth from the latter group to the former. The informed operator is what Wyckoff called the composite man. This is the professional entity that controls the market's major movements. Analyzing price action requires adopting this perspective. The market must be viewed as if it is controlled by a single, well-financed mind. This mind is always focused on profit. The composite man is defined by patience and calculation. Unlike the public, the professional never acts on impulse. Every operation is planned weeks or months in advance. The goal of the composite man is to systematically accumulate shares at low prices. Then, the goal shifts to selling those shares at high prices. This requires campaigns designed to mislead the less informed traders. During the accumulation phase, the composite man works to absorb all available supply. This often involves creating periods of weakness. Weakness encourages the fearful public to sell their holdings. The professional operator understands that buying requires selling. Supply must be transferred from weak hands into strong hands. This transfer must occur quietly, without attracting widespread attention. Once the accumulation is complete, the composite man initiates the markup phase. This is the period where demand begins to exceed supply significantly. Price advances strongly, confirming the professional's earlier commitment. The composite man then begins the distribution phase. Distribution is the systematic unloading of inventory. This occurs when the public is feeling optimistic and eager to buy. The professional uses positive news and rising prices to attract new buyers. They liquidate their large inventory slowly, ensuring that the heavy selling does not cause the price to immediately collapse. The methods of the composite man are always deliberate. They use specific tactics like the spring or the secondary test to confirm their positions. These tests ensure that all remaining supply has been absorbed before the true markup begins. A key characteristic of the composite man is the ability to wait. They wait for the proper technical setup. They wait for the public to become either entirely discouraged or overly enthusiastic. They never chase price action. The composite man uses volume analysis as a primary tool. They look for evidence of absorption, supply being quietly taken off the market. They look for signs of effort versus result, determining if a price move reflects true professional sponsorship. The professional trader knows that every large movement requires a significant period of preparation. The accumulation structure is the cause. The subsequent advance or markup is the effect. Understanding the composite man's behavior is fundamental to applying the Wyckoff method. It shifts the focus from reacting to news to interpreting the calculated actions of the informed operator. It requires thinking in terms of strategic campaigns, not daily fluctuations. The strategic campaigns of the informed operator stand in stark contrast to the typical behavior of the general public. The public trader is defined by reaction, not calculation. Wyckoff identified that this group consistently makes trading decisions based on emotional impulse. Their focus rests primarily on external factors. These factors include media headlines, company news releases, and general economic sentiment. The professional operator understands this predictable psychology. They know that the public will react strongly to narratives, ignoring the underlying supply and demand dynamics visible on the chart. The news is often the catalyst used by the professional to execute their plan. If the composite man needs to accumulate shares, negative news may be released to encourage widespread selling. This creates the necessary liquidity for the professional to absorb inventory at lower prices. Conversely, during the final stages of a major markup, extremely positive news often surfaces. This narrative of unlimited growth attracts the public buyer precisely when the professional is ready to distribute their holdings. Impatience is another defining characteristic of the public trader. They are looking for immediate results. They often enter positions late, only after the trend has already been firmly established and confirmed by a significant price move. When a normal reaction or pullback occurs, the public trader panics. They lack the conviction required to hold through volatility. They sell their positions at a loss, often just before the professional resumes the primary trend. This behavior ensures that the public acts as the necessary counterparty to the informed action. They are consistently buying when they should be selling, and selling when they should be buying. The public's failure to succeed stems from a fundamental misunderstanding of price action. They prioritize the reason why the price should move over the objective evidence of how the price and volume are actually behaving. They often chase momentum without verifying the professional interest behind the move. A sharp increase in price on low volume, for example, might trigger widespread buying from the public. However, the professional operator recognizes this as a sign of weakness and lack of real demand. The composite man relies on the public's emotional instability to complete the accumulation and distribution phases. The successful execution of any major campaign requires the transfer of shares from weak hands to strong hands and then back again. The professional trader views the public as a necessary, predictable source of liquidity. Their emotional trading provides the fuel needed to move the market through its cycles. This process of transfer defines the structure of every major price movement. The transfer of shares from one class of owner to another is the necessary prerequisite for the next major movement. This process is inherently competitive. It requires a winner and a loser for every transaction. It is a zero-sum game played between the professional operator and the uninformed public. For the professional to accumulate a profitable position, shares must be acquired from those who are eager to sell. This eagerness to sell is driven by fear. It happens when the price has fallen significantly, often reaching the critical low point known as the selling climax. The public, acting on emotional impulse, liquidates their holdings at depressed prices. They believe the market will fall indefinitely. The professional operator views this panic selling as a unique opportunity. They absorb the supply, systematically taking the shares off the market. The ownership is transferred from weak hands to strong, calculating hands. This accumulation phase cannot be completed without the public's cooperation. The public must provide the necessary volume through their panicked selling. Conversely, the distribution phase requires the opposite dynamic. The professional operator must dispose of their inventory at high prices. This requires finding buyers who are motivated by excitement and greed. The professional sells their shares when the public is most enthusiastic about the market's potential. This often occurs near the top, marked by a buying climax or an upthrust after distribution. The uninformed buyer enters the market, believing the advance will continue forever. They are willing to pay elevated prices, taking the shares from the professional operator. The financial cost incurred by the public is directly proportional to the professional operator's eventual gain. The market mechanism is designed to capitalize on the public's predictable emotional swings. Wyckoff observed that the professional trader waits patiently for these critical transfer points. They understand that the public's emotional reaction to extreme prices provides the necessary liquidity for major operations. Without the panicked seller at the low and the euphoric buyer at the high, the professional operator cannot successfully complete their plan. The transfer of ownership is the core function defining the transition between all market cycles. The professional trader observes that this continuous transfer of shares is not random. It is governed by structural principles. Richard Wyckoff formalized these observations into 3 fundamental market laws. Understanding these laws is essential for reading the market tape correctly. They provide the necessary framework for differentiating between genuine strength and manufactured weakness. The first structural principle is the law of cause versus effect. This law dictates that nothing happens without adequate preparation. Every significant price movement must be preceded by a corresponding period of development. The period of accumulation serves as the cause. The ensuing sustained uptrend is the effect. Similarly, the distribution structure is the cause that leads to the downtrend effect. The size of the cause determines the magnitude of the effect. A long, sustained accumulation phase must produce a large, sustained markup. A short, shallow cause will only yield a small, fleeting effect. The professional operator spends months building their position, knowing that this preparation time is the foundation of the resulting price move. The composite man is patient. The uninformed public expects immediate results. The second critical principle is the law of effort versus result. This law directly measures the relationship between activity and price movement. Effort is strictly defined by the trading volume flowing through the market. The result is the corresponding change in the price bar range. In a healthy market, effort and result must align seamlessly. High volume or great effort should produce a wide price spread and strong movement in the direction of the prevailing trend. When effort and result diverge, a critical warning is issued to the careful observer. This divergence signals that the underlying supply and demand balance is shifting dramatically. If volume is exceptionally high, yet the price spread narrows significantly, the market is experiencing intense friction. This means strong selling pressure is meeting equally strong professional buying. The professional operator is absorbing the supply being offloaded. The high volume represents the effort, but the lack of price progress represents the failure of the result. This divergence signals that the existing trend is likely approaching exhaustion. It shows the composite man is preparing for a major reversal. When the market fails to move higher on massive volume, It means sellers are overwhelming the buyers. The professional trader recognizes this immediate sign of weakness. The uninformed trader sees only the high volume and assumes strength, often buying right into the hands of the distributing professional. The Wyckoff trader sees the lack of result and prepares to sell. These two laws allow the professional to anticipate the future direction of the market based on the current character of price and volume action. They provide the necessary guideposts for identifying when the transfer of shares is nearing completion. The professional operator must acquire their inventory at the lowest possible prices. This necessitates inducing the public to sell their shares in panic. Wyckoff observed that this transfer of shares occurs most efficiently during the market's lowest point of fear. This moment is identified as the selling climax. The selling climax is characterized by extreme downside volatility and massive volume. Price plunges rapidly, often breaking significant support levels. The action is designed to trigger margin calls and emotional capitulation. The professional uses this sharp decline as a cover. They step in quietly, absorbing the vast quantities of shares being dumped by the public. This absorption is the critical difference between professional and public action. The public sees the plunge and rushes to liquidate. The professional sees the liquidation and rushes to accumulate. The volume signature of the selling climax is exhaustion volume. It represents the final, desperate supply coming to the market. This supply is immediately met by the composite man's organized demand. Once the bulk of the supply has been absorbed, the selling pressure suddenly vanishes. Since no sellers remain, the slightest bit of demand causes a sharp, immediate reversal. This is the automatic reaction. The price snaps back upward rapidly from the low. The automatic reaction serves two purposes. First, it confirms that the heavy selling has been successfully met by heavy buying. Second, it traps the public trader who just sold at the absolute low. The trader who liquidated during the panic is now forced to watch the market rebound without them. They are now locked out of the potential move. Following the initial excitement, the professional must ensure the accumulation is complete. The market enters a crucial testing period. This test is usually the secondary test. During the secondary test, price returns to the area near the low of the selling climax. This movement is a deliberate probe for remaining supply. If the public still holds shares and is willing to sell them near the low, heavy volume will appear on this test. This signals that the accumulation is not yet finished. However, if the test shows drastically lower volume compared to the climax, it confirms success. The weak hands are gone. The supply has been successfully absorbed into the professional's inventory. The secondary test on low volume is the professional's confirmation signal. It validates that the trap is set and the market is ready for the next phase, the slow, deliberate markup. This entire sequence, the engineered panic, the absorption on high volume, and the confirmation on low volume, is the professional's playbook for trapping the uninformed trader during accumulation. The successful markup phase naturally concludes with the initiation of distribution. The professional operator, having accumulated shares cheaply, must now unload that inventory at significantly higher prices. This selling must be done without collapsing the price prematurely. Distribution is, therefore, the mirror image of accumulation. It is a slow, methodical transfer of shares from strong professional hands into the weak hands of the uninformed public. Wyckoff observed that this process always occurs when optimism is at its peak. The public is usually excited by positive news or the belief that the current trend will continue indefinitely. The first hint of this shift appears as preliminary supply. Volume begins to increase notably, signaling that professional selling is entering the market. This selling is immediately absorbed by enthusiastic public buyers. The climax of this buying frenzy is the highly visible buying climax. This event is characterized by extremely high volume and wide price spreads as the last buyers rush into the market. The professional is selling aggressively into this demand, using the public's excitement as perfect liquidity. Once the buying power is exhausted, the market experiences a sharp, immediate drop. This is the automatic reaction, and it establishes the lower boundary of the distribution trading range. The subsequent rally is the secondary test. The price attempts to return to the area of the buying climax. If this test occurs on significantly lower volume and fails to exceed the previous high, it confirms that the professional supply is still dominant. The effort to push prices higher is met with little result. The composite man's objective throughout this entire range is to deceive the public. The public views the trading range as a simple pause before the next major upward move. They continue to buy, believing they are securing a position at a temporary discount. In reality, the professional seller is systematically supplying all that demand. This phase includes the upthrust after distribution, a final deceptive move above the trading range highs. This move traps any remaining professional bears and convinces the public that the true breakout has finally occurred. This maneuver ensures that the maximum number of public traders are long just before the final markdown begins. The distribution scheme is complete when the professionals have successfully converted their paper profits into cash. The shares are now held by those least prepared to withstand the inevitable decline. The stage is set for the final phase of the cycle, the markdown. The markdown phase is triggered when the professional operator ceases their support. Reading the market's true intent requires more than simply observing the price bar. It demands a detailed analysis of volume. Volume represents the energy or the effort exerted by the forces of supply and demand. Price represents the result of that effort. Wyckoff's second law, effort versus result, focuses entirely on this relationship, and the professional trader constantly looks for discrepancies between the effort and the resulting price movement. When high volume fails to produce a proportional price change, it signals the presence of the composite man. This high volume, narrow spread action is often called absorption. During the accumulation phase, absorption occurs when professionals buy up all the available shares from weak hands. They are absorbing the supply. The price may consolidate, moving sideways or slightly down, but the heavy volume shows that massive buying is taking place beneath the surface. Similarly, during distribution, professionals are absorbing demand. They are selling large amounts of inventory into the market without causing the price to crash immediately. The public is buying heavily, convinced the trend will continue, but the volume is being met by organized professional selling. This is the key to reading the tape. Understanding when volume is confirming the trend and when volume is contradicting the trend. A strong, healthy markup phase should show increasing volume on up moves and decreasing volume on minor corrections. This confirms that demand is dominant and supply is scarce. Conversely, if the market has experienced a significant run and then hits a new high on extremely heavy volume but with a very narrow price spread, this is a warning. The professional operator recognizes this as potential buying climax activity. The effort is high, but the result is minimal. The market is struggling to move higher because the composite man is unloading inventory. The subsequent secondary test is also read using volume. After a major low, the market often rallies, then returns to test the level of the selling climax. If this test occurs on significantly lower volume than the original low, it confirms that supply has been successfully absorbed. The lack of selling pressure on the test demonstrates that the weak hands are gone. The path for the markup phase is clear. The professional trader never relies on price alone. Price can be manipulated. Volume tells the story of who is participating and how strongly they feel about the current levels. Identifying professional volume that is organizing, absorbing, and preparing for the next phase, is the superior skill Wyckoff taught his students. It separates the informed operator from the uninformed speculator. The informed operator focuses exclusively on the market's own story. This story is written directly in the price action and the volume footprint. This practice is known as trading the tape. Trading the tape means interpreting the immediate supply and demand conflict. It requires reading the bar-by-bar movement of the price. It demands attention to the relationship between the price spread and the accompanying volume. Wyckoff believed this physical evidence was the only reliable guide to market intent. The opposite approach is trading the narrative. The narrative involves news stories, analyst upgrades, economic forecasts, and social media sentiment. These external factors are often used by professional interests. They serve primarily to distract the public. The narrative creates emotional conviction at the precise time the professional is doing the opposite. Consider the phase of accumulation. During this phase, the news flow will be overwhelmingly negative. Stories of corporate failure or macroeconomic doom are prevalent. This justifies the public selling their shares at low prices. The composite man uses this fear to acquire stock cheaply, absorbing all selling pressure. Conversely, during distribution, the news is overwhelmingly positive. Hype builds around future prospects or new products. This narrative creates excitement just as the professional operator unloads inventory onto eager, emotional buyers. The public mistakenly believes the narrative is the cause of the price movement. Wyckoff showed that the professional operation is the cause, and the narrative is simply the effect, or often the camouflage. Shifting the mindset requires strict discipline. It means disregarding the headline noise. It means ignoring the expert opinion that does not align with the chart evidence. The price action and volume on the chart provide a direct, unfiltered window into the intentions of the informed money. The tape shows the struggle between buyers and sellers. It reveals the absorption of supply. It confirms the commitment of the professionals. The tape never lies about the current relationship between supply and demand. The external narrative, however, is often designed specifically to mislead the uninformed speculator. The superior Wyckoff approach insists that the most profitable operations occur when tape reading confirms the underlying major trend. If the tape shows professional accumulation is complete, the operation should only be executed if the major trend is moving upward. This harmony between structure and immediate action is essential for safety and profitability. Safety and profitability hinge on recognizing the dominant market direction. The major trend is the ultimate shield against sudden, unexpected losses. Professional operations are always executed in harmony with this larger movement. Trading against the primary trend is the hallmark of the amateur trader. They attempt to pick tops during strong uptrends or bottoms during relentless downtrends. This is pure speculation. It is not skillful trading. The professional operator understands the path of least resistance. If the market structure shows accumulation is underway, all short-term setbacks are treated as buying opportunities. If the structure shows distribution is dominating, all rallies are treated as opportunities to liquidate holdings. The ultimate goal is capital preservation. Richard Wyckoff stressed repeatedly that the first law of speculation is defense. This defense relies on strict adherence to risk management protocols. Properly placed stop losses are non-negotiable. They must be honored without exception, allowing the trader to accept a small loss rather than risking a large one. The error of averaging down or adding to a losing position is one of the most destructive habits Wyckoff identified. This practice turns a minor mistake into a catastrophic loss. The professional trader refuses to gamble. They treat trading as a formal business enterprise. This requires meticulous record-keeping, dispassionate analysis, and strict adherence to a predefined plan. Emotional impulse has no place in the decision-making process. The successful operator must learn to judge the market solely by its own action. They ignore external news, rumors, or personal hopes. The movement of price and the associated volume tell the complete story of supply and demand conflict. Reading the tape accurately means aligning oneself with the composite man. This alignment provides the ultimate defense. It ensures that the trader is never caught fighting the overwhelming force of the market's primary direction. It transforms the act of trading from a high-stakes guessing game into a methodical, structured business operation. The transition from the public mindset to the professional mindset requires this deep, fundamental shift in perspective. The complete framework for mastering this professional approach is detailed in Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless text containing his foundational wisdom on risk management, judging market action, and establishing trading as a serious business. For maximum clarity, seek the annotated edition by Max Davidson. This version includes the original text alongside explanatory notes that clarify the context for the modern reader. The link to this book is in the description below.